All right, coming to the stage now is an incredible panel full of insight, full of information, and the panel is going to be led by the one and only Jill Scher, CPA of Marcum LLP. Let's hear it for Jill.
Oh, thank you. Thank you, babe. Guys. So, hi, good morning, everybody. My name is Jill Scher. I'm a partner at Marcum LLP. I'm based in New York, and we're a full-service accounting firm. I'm a tax partner, and so happy and pleased to be here and have this awesome panel of gentlemen in front of me. We have John from FocusGrowth Asset Management over there. We have Len from AFC Gamma. We have Jack from Seaport Global. And we have Travis from Pelorus Equity. So pleased to be here. And before we kick it right off, I'm just going to let each gentleman introduce themselves, and then we'll take it from there. So John, why don't you start?
Sure. So my name is John Lykouretzos. I'm the CEO of FocusGrowth Asset Management. Started FocusGrowth a couple of years ago. We're raising our second fund now. We've deployed a little over $400 million across 14 investments with 12 companies. We're a really flexible financial partner, and a couple of my partners, the guys who lead the underwriting teams, come from the cannabis industry. So I have a history in long-short equity. My partners were institutional asset management on the credit side, but over a 4-year period, won licenses, activated licenses, built greenfield facilities, engaged in M&A, and now we're deploying capital on behalf of investors.
Len Tannenbaum from AFC Gamma. We are a public company listed on NASDAQ, symbols AFCG. We are a mortgage REIT. We lend money to companies in the cannabis industry secured by licenses, cash flows, and real estate. Some of our more notable loan parties are Verano, Acreage, Justice Grown, Nature's Medicine, and this morning we announced the $82 million deal with Bloom. So we're in the limited license states. We really don't do California, Oregon, Washington. We may do Colorado if we find the right player, but and we're pretty much a little bit scared of Michigan. But we're really focused on good operators, pretty much in the mid-tier to help them grow.
Hi, I'm Jack Mascone. I work at Seaport Global, where I'm the head of capital markets. We've been pretty active in the cannabis sector for about 30 months now. We're primarily involved in the arrangement of debt and equity-linked debt on both the public and private side. And since the end of 2019, we've been lead placement agent on roughly $1.45 billion of various forms of debt in the cannabis sector.
My name is Travis Goad. I'm a managing partner at Pelorus Equity Group. We're a private commercial mortgage REIT. We specialize in both construction and stabilized lending in any legal market. So we will go to California. We will go to other markets. We have done about $350 million in loans since inception. Today we have about $280 million in AUM. We've been growing at about 15 to 20 million a month in equity. We recently closed the State House deal, which is a very large three-way merger loan that we closed, one of the first in our stabilized lending program, $77 million loan as part of the Harborside roll-up.
So thank you very much. That was very great. You all very impressive. So the first question is, you all lend to the cannabis industry, and how would you differentiate yourselves from the others on this panel? You all have different strategies and ways you go about doing business and methods. So Len, why don't we start with you, and we'll take it from there.
Look, the cannabis industry is desperate in need of capital in general, as all of you guys know, and you've also seen a backup in rates in general. Even in the middle market, rates are now up in the past 2 months, almost 150 basis points. So we need partners, and I would say FocusGrowth and I are working on a large deal together for the last 9 months. It's been in our pipeline, but their underwriting team's so good, I let them do the hard work, and I'm sort of piggybacking a little bit on that one. Jack and I have done many deals together. In fact, Jack was one of my lead book runners, and we participated with Jack in the numerous deals that he's done, and maybe giving some advice, where I saw the market, and Jack gives me a lot of advice on where the data points are, and Pelorus I've known since they were $10 million. and,
right.
and I respect a lot about what they do in the market, which is actually very different than what we do. So we try to partner in general with the industry. We need multiple people, multiple lenders to really satisfy, the outcome. And even in acreage, somebody who's not on the panel, like Viridescent, we partnered with Viridescent, who is 30 million, and we were 70 million of the 100 million to acreage. So, it's about partnership, and that partnership program is really interesting because you get dual underwriting, right? It's not just one set of eyes, it's two sets of eyes or three sets of eyes. And to me, the more sets of eyes, the better.
All right, Jack, I know you don't lend directly, but why don't you talk a little bit about what you do?
Sure. So, we arrange capital for various borrowers in the sector, and as Len said, we've been involved in with the companies that are financing directly these three firms, but we've been primarily raising capital for the MSO sector. And the big difference, as you hit on, we don't act as principal. We're a placement agent or an underwriter, depending on the deal structure. And what I would say is, we broaden the audience of prospective lenders, and we typically bring I don't want to say not expert, but not exclusively focused cannabis investment capital to these opportunities. And that resonates and works for some of the borrowers in the sector, and it doesn't work as well for others. And I think that line of demarcation is where you see a big difference in some of the transactions that we're all involved in.
Anyone else want to comment? Travis?
Yeah, so what we do is a little bit different. Most of the people on the panel here are much more, when you think about the cannabis sector and real estate REITs within it, it's very much a hybrid of real estate and corporate lending. And if you think about it on a continuum, some of the guys on the panel here are a little bit more on the corporate side, where we are much more focused on the real estate side. So kind of the trade-off there from a borrower perspective is we will lend against the value of your real estate only, not the value of some of the other things, even though we're collateralized by the OpCo and PropCo. But we also don't come with a lot of corporate covenants, and we provide more flexibility as you grow your business.
Awesome. And John?
Yeah, I think I would just add, I think one of our biggest assets is to just be a flexible financial partner. Our mandate is invest in the cannabis industry. We can do senior secured, we can do unsecured, we can look at mezz, we can be really creative. I think having people who have decades of experience in institutional asset management, plus the cannabis operating expertise. And Len, thanks for the comments. I'll pass it on to the team. I think they're fantastic as well. But yeah, I think we can work and partner with other people to really solve. We can be the fulcrum capital to solve the problems, and we have a lot of flexibility and like to think creatively about solutions.
Great, thank you. So you're all slightly different, or very different. So if I'm an investor and I'm looking for a good place to put my funds, right? How would you describe, you all said real estate, you said corporate debt, equity. Can you just explain what the nuances is? Where's the best place to put my money is as an investor? What would you tell me?
I'll start, then I'm sure we're going to have a lot of things to add here. Obviously, first thing I want to know is, what are your goals?
I want to make a lot of money.
So you're 25 years old and you want to
very little risk.
Grow your capital.
I want to be rich.
But the second thing I'd say is, I think a lot of people in the room, and we all have experience, the direct investments into private cannabis companies in 16, 17, 18, 19, right? Those ended badly for a lot of people. So I would advise, I did not want to be a single family office investor, passive and illiquid, providing money to the cannabis sector. So I would say that, sure, institutions charge fees, but know that people are acting as a fiduciary on your behalf to protect your capital. And in most cases, we're our largest investor at FocusGrowth. It's great, we're protecting capital next to ours. So what I would tell you, though, depending on what your goals are, we saw the greatest opportunities over the last couple of years in credit, equity-like returns without the equity risk. Obviously, over the last year, I think the equation shifted a little bit, and we're hopeful that we can find some interesting equity opportunities.
And I think John brings up a really good point. If you're an investor in family office, and I am, I sold my company to Oaktree 5 years ago, became a large family office. We ran a $5 billion asset manager. I did $1 billion in middle market loans every year. I didn't intend to come into cannabis. We found it. The alpha, when I spoke to my peers, they couldn't enter, so I entered as an institutional player. And it's really hard, right? We have 31 people. It's a lot of underwriting. It's a lot of data. We're very data-centric focused. I own 17% of the stock personally. So you're investing alongside me when you buy AFCG. We do have other entities too. I'm also on the operations side. I have a large stake in a MSO that hopefully Cowan over there is gonna monetize for us. And so they're sitting over there. I see them. So I think it's very exciting industry. I think it's also super dangerous. You really have to understand the cash flows. You have to understand and add back the leases if there are leases. You have to add that to the debt load. There's a lot of nuances to this category. So I don't think this is for people that are really steeped in it. I think you do have to hire experts or invest with experts if you're doing this. You really shouldn't just believe that story, get really excited, and try it alone. Definitely get some opinions of people who've done it before.
Yeah, I mean, I agree with all that, of course. The other thing I would add, when we talk to companies about whether we can help them raise money, we're really attuned to the quality and sort of the philosophy of the management teams. And I think the biggest differentiator is just that. The management teams that have a responsible view for their business going forward. When they're employing debt in their capital structure, it's a pretty tricky proposition when you think about the dynamic nature of the regulatory and legal environment, a lot of which people can't control right now. And so we look very closely, and I think from the standpoint of making money, you have to understand these management teams because things change too quickly. Without a steady hand on the rudder, you can be in trouble fast.
For sure. Travis?
And I'd say something you'd want to look into is track record and data-centric focus. So we're the longest running commercial mortgage REIT. We have the most payoffs, over 26 payoffs in our portfolio. We've been doing this the longest, and we have the returns to show for it. The way I would think about it, if you as an investor want exposure to the space, you're basically coming in and getting a secured position with near equity-like yields in a debt position, which kind of insulates you from a lot of the volatility that we've seen in both the public equities and the value of the equity and the dilution and issues that they've had on that side. So we think it's a really attractive way to get exposure to the cannabis market.
All right, that's helpful. Thank you. So when you're looking at a potential cannabis company to invest in, what do you pay attention to the most? Are you looking at cash flows? Are you looking at the value of a license? Are you looking at the real estate? Do you look at hard assets? If you were looking at each of the categories, what do you give the most power to in that equation? Is there some sort of algorithm that you come up with? What do you do? Like, what's the actual process? What's your secrets? Len, you look like you want to talk.
That's a great question, and you articulated that very well. It's cash flows, licenses, real estate. You guys remember that? So those are the three basic tenets of any loan that we're doing. And I have to say, it really starts with any of them. So if you have a really, really strong license, like an ATC license in New Jersey, and you're one of the 12, and 7 of them just got turned on to rec, that's very valuable. You're seeing these New York verticals go for $200 million, and Attain get bought. That's very valuable. And that's just, even just the piece of paper is pretty valuable. So that's one side of it. Or Georgia, which could be worth, $50 to $100 million, because there are maybe only 6 of them. So if you look at that, that's license side. Cash flow side, they've got to have cash flows. We're lending to them. If you're lending money, they've got to be able to pay it back. They've got to fix charge coverage ratios, which means taking all of their cash flows and expenses, they've got to at least cover all of them from cash flow eventually. And then it's got to get from like 1 to 1.5 in our case. It's got to get up there. Debt to EBITDA has got to get down in that 3 range in the next 12 months. So cash flows, licenses, and then real estate's important, right? But real estate is, to me, one part of the equation. I get I'm a mortgage REIT, right? But real estate's part of the equation. The reason the real estate's really important is, God forbid something goes wrong, you have to have these access agreements. You have a whole other third party. Owning the real estate is a powerful tool in terms of making sure that we're secure from a loan side. So we do like to own the real estate or have our companies own it, but we're also willing to loan money, in different circumstances.
Yeah, I throw in there, and I think Len alluded to it, it's a multi-faceted underwriting approach, and the state matters. And not only for licenses, but you take a picture looking back, what's the history of the program in the state, looking forward, how do we think the licensing will evolve, who are the competitors and the players. There's some states, because we think the licensing structure is just disadvantageous to any player, West Virginia, for example, that Rhode Island, I just don't think we'll ever get involved in those states. We have our favorite states as well, but the one thing that I think trumps all of this is just management. You know,
What are your favorite states? What are your favorite states?
That's
limited
my
license.
next question, Len.
You know, management. So we like to see assets and cash flow, but push comes to shove, I'd rather see the cash flow, and I want to see an operating history where we can really assess the abilities of management. And a lot of times, since this is such a new industry, the most successful entrepreneurs in cannabis have had success in other careers prior to entering cannabis. Right? So when we try to underwrite a team and understand the management team's history, it's great when they're bringing a lot of cash to the table as well, and we can partner with them and grow the enterprise.
Can you, go ahead, Travis.
I'd just say the number one thing we look at is real estate value, because we're very focused on the asset value, but it's also the management teams and what we think they're going to be able to do and accomplish. I mean, we really like to find relationships that we can grow over time and do multiple deals with, and people that you can trust. And when you're in a industry that's new, such as this, a nascent industry, as you see the maturation of this industry and more professional people getting involved and everything else, it's the people that we want to do business with and help grow.
That's great. Okay, so you touched on it a little bit, and I'm curious about this. So every state is different, right? The regulatory environment, there's just no way to figure it out. Some states are limited license, some states are unlimited or not limited. Some states require vertical, some states don't allow it. How do you figure out where the best place to put your money is? What is the best state to be in your mind right now?
I think Len should start.
Tell us your
I'll pile on
secrets.
after.
Come on, John. You got this.
Look, it's not static, right? So we love the limited license states that are medical only. We don't underwrite to a change to rec, but you know, look at Illinois, and you saw what happened to growth in Illinois in 2020. Ohio, Missouri, Pennsylvania, Maryland. Right, Florida, I think over time will go rec, and then there's a chance for the vertical license to change. New York, New Jersey, you know, it's kind of early. If we do stuff in New York, I don't think it'll be in New York City. I think the willingness and ability to police, which is really plaguing California, you need both things, the willingness and ability to police the illegal market. I think the willingness and ability will be very low in New York City. And then in New Jersey, again, TBD, but we worry that there might not be enough dispensaries. And you know, some states really hit the nail on the head. I like some of the OG states. Like I like Oregon. I like Colorado. I'm not afraid of those states. You know, the price is low, and if you can find companies that have good brands, good SOPs, good sourcing, are well run, that are generating mid-teens or 20s EBITDA at $1,200 a pound, you know, I like backing those companies. It's the other states that aren't limited license where the price is still in the 3s or 2s or high 1s that I'm a little worried, because I think as the tide goes out, you know, at this point we just don't know who the winners are going to be.
And even limited license states change. You have to watch the changing dynamics. Let's give new data points coming across our desk, and we look at billions of dollars. I think we've looked at over $10 billion of deals in the last 18 months. So we have a lot of data and data collection. Pennsylvania prices are plummeting in terms of grows. So the grow in Pennsylvania is a lot less attractive than it was a year or two ago, but the dispensaries are still great. And so I really like the dispensary locations because of the barrier to entry in the local markets of approving those. I think New Jersey is going to be fantastic. I think 13 dispensaries is not going to cover the state, but once that expands a bit, it's going to be terrific. You have lines out the door this morning. You're going to see a lot of news coverage today all about that. We're very excited about Ohio. We put a lot of money in Ohio. This morning's deal we did is going vertical with a C1 in Ohio with great dispensaries. I think you've got to be vertical. There's another whole part of this, right? Whatever state you're in, sometimes the dynamic, and Arizona's a good case of this, where you really want to be a grower in Arizona and not a dispensary. And sometimes you want to be a dispensary and not a grower. Right now you want to be a dispensary, not a grower. But if you're vertical and you're covering your own product, you're insulated from that volatility. And I think that's another part. Even if you're in a good state, because of the volatility within the states, being vertical is really important.
Anybody else have any comments on that? No, Travis?
These guys are hitting the nail on the head.
How do you guys feel about New York? So I'm from New York, right? What is your thinking there? You saw like the legislation, the proposed legislation on what's coming out. When you see the first couple of dispensaries come out, would you invest in those dispensaries? They require, you have to have social equity. They require a conviction for the first couple of dispensary licenses that they're giving. Is that something investable for you?
You want me to do New York? So New York, we just don't know yet. That's the problem. New York is just up for grabs in terms of the tax. I'll give you an example before we get an example relevant to New York. We talked to numerous people from Missouri and the governor of Missouri, and what Missouri's thinking about is cutting the taxes in half that Illinois is charging. So while the Illinois market you think is good, if Missouri's going rec, which I think it will, they've got the signatures, and everybody's rent now crossed from Missouri to Illinois, it's going to happen in the opposite. Everybody's going from Illinois to Missouri. So that's going to change the whole dynamic in Illinois. It's going to really make the Missouri, we're excited about Missouri, going to make Missouri really great. You've got to watch those changing dynamics. In New York, we just don't know. All we know is it keeps getting delayed, you know, the different social justice things. Having said that, my wife, who co-runs the company with me, and I are in a New York vertical license personally. And so, you know, it's we understand the New York search and how that's all working from the inside. Just like FocusGrowth, you know, we're not only lenders, right? We're also active in the industry on the operating side, and that's how we learn, right? Because you really learn by being operators. You don't learn by being lenders, and that's why you can identify with your clients so much better.
That leads me to, go ahead, Jack.
I was just going to add, you know, I obviously everything that was said is true, but I think from a lending case, New York is very investable, and you know, institutional participants are excited about the
Yeah, it's going to be a
opportunity.
huge market, right?
Yeah.
I mean,
I think those risks manifest themselves a lot more through the equity valuation, but when you're at the top of the capital structure, New York is very viable.
yay, New York. Okay.
Yeah, we agree. We're actively targeting stuff in New York and looking at deals now. It's very investable.
Awesome. All right, cool. Good to hear, because I'm right there. So let's talk about rates. What are the rates that you see in this market for when you have like comparing MSOs to middle market to, you know, the single state operator that maybe is just trying to get a license? What kind of rates are they looking at?
So, you know, the rate picture has backed up a little bit in the last 4 months. But if you take a view from 3 years ago, you know, we were fortunate enough to do a deal for Cureleaf in late 2019, and that deal priced at an effective yield of 14%. Wow. It was a $300 million deal. It had about over 2/3 participation from family office and what I would call non-traditional, non-institutional investors. Last fall, we refinanced that deal at 8% at par, with about more than 75% of what I would characterize as institutional or professional investment capital. So the migration of new participants into the cannabis market, particularly on the debt side, is prolific, and it's going to continue to lower everybody's cost of capital. Now, having said that, today, not every private and public borrower in the cannabis sector has access to those types of investors, but I think the better companies certainly do, and we'll see. You know, the real story here from a macro perspective is this risk and the structures that you can get in this sector, notwithstanding how nuanced, how difficult it is to underwrite, these are very attractive relative value lending opportunities for institutional investors. And that is going to continue to be the case for a while. And I think that as investment professionals see the inevitability of some form of safe or something that permits more normalized banking activity, they're finding ways to come into these deals. And that's going to continue. It's not a straight line, but that's going to end up benefiting primarily on the debt side everybody's cost of capital.
So is that a good thing for you from your perspective? Do you like that rates are going down and more lenders are coming in? Or are you guys like, this is my thing and I don't want all these people now coming into it?
Yeah, so you know, these are the best in class type lenders, right? And but what I would tell you is the bigger companies with the more easily understood capital structures are probably the ones, or certainly the ones with the most options. But I think the distinction of the companies that need capital is where, especially these folks, you know, are going to make very good returns for their investors.
But I don't
they have the expertise.
I don't believe there's 8% money anymore. I think this Cureleaf bonds now, which I own some of, and I was one of those early owners through Jack, are now trading at 96. So you've got to, that doesn't include fees that Seaport charges or Canaccord charges. You know, so if you really think about the rates of these things, the companies are borrowing in double digits. And, you know, so everybody says, oh, there's 8% money. There's no 8% money. First of all, middle market loans are wide of 8% now, normal middle market non-cannabis. And the best example I give is where I'm the largest shareholder at Oaktree, where if you look at some symbols OCSL and you look at their bonds, they issued 9 months ago at 2.7% triple B. Today, those same bonds, and I bought some yesterday, are 5.1%. Okay, that's Oaktree. We're talking about sold to Brookfield. We're talking about one of the best managers on the planet, to me. I think Howard Marks is amazing. And that's 5.1% no risk. Cannabis is going to widen out, and we're already seeing it. We're seeing rates rise for the first time. I think it bottomed out when Jack did amazing deals at 8% for a couple of his clients, including AYR, I think you did an amazing deal for, and got them an incredible rate, which is great. And that's what Jack can do because he pulls in people from that we don't pull in, right? He pulls in people that we wouldn't think about talking to because he knows them because he's a credit shop. But that's not going to happen. And you can see where these things are now trading. So I'm excited because I think rates are backing up to a reasonable level, and I think they're going to continue backing up because the demand for capital is far in excess of the supply of capital.
What are the higher rates, though, for the single state operators and the less, you know, organized type of cannabis companies? What rates are they getting? And do you make it, you know, a principle of yours to actually give them funding, even though they might not be as strong as other companies?
Look, I think it's a dynamic risk-based pricing, you know, based on what state, the operating history, the collateral, the cash flow, the level of debt they want to take on, the uses of the debt. And then I would say that, sure, if you're a single state operator, your risk is centered in one state. So you see these companies with a lower multiple. I would not necessarily conclude that the single state operators aren't as good an operator as some of the multi-state, because we've seen a lot of the multi-state, even in the public markets, that historically are really bad operators, and you might see, you know, in a single state, depending on the state, you know, the market-leading company with fantastic margins and good cash flows. So we really take everything into account. And then just one other comment on the institutional versus non-institutional. It's a lot of work to do these deals. You know, Len alluded to, we've been working on a deal together for 10 months. And it's not uncommon. I was talking to some of my teammates. One of our favorite loans from last year, we engaged with the company in April. We funded late November. It's a great operator. They don't have a data room. They don't have audited financials. You're doing QOE reports. You're bringing in, you know, people and constructing financial statements from QuickBooks and bank accounts. It's a lot of work. So I understand why if Jack's doing a $300 million deal for a public company, a family office is going to write a $20 million check and be like, oh, 8%, we're super happy. But the family office isn't going to invest 6 months to put $25 million to work to earn 19%. They don't have the skills, the talent, or the time.
Yeah, no, I agree with that. There's a dedicated expertise up here and with some other folks at the conference that the types of investors I'm talking to, for the most part, not entirely, but for the most part, number one, they don't have it. Number two, they don't want to have it.
Right.
It is a lot of work. It is a lot of
work.
resource allocation. And those are generally not borrowers that are looking at the types of situations that we're involved in. But I think that's going to be the opportunity set that these guys exploit going forward. I mean, you know, this is going to become a more normalized sector from a financing standpoint. Maybe, I don't know when, I don't think anybody knows when, but when that happens, the migration of new capital is going to lower.
Right, which makes it exciting.
Yeah.